Despite holding 1/3 of the world's mineral reserves and generating 2/3 of the world's diamond production, the mining sector in Africa has traditionally been viewed as high risk. Reasons for this include underdeveloped infrastructure and regulatory frameworks, as well as labor issues and the drag of bureaucracy. Some even expect 2016 to be the most testing year for mining on the continent. How does Africa's mining outlook compare to that of other emerging markets? Well, that's what we're going to discuss tonight on the CNBC Africa special. And joining us to take matters further is Andile Sanqu, Vice President of the Chamber of Mines of South Africa, Wickus Botha, Mining and Metal Sector Leader at EY Africa, Philip Lindop, Head of Investment Banking at Barclays Africa, Bernard Swanepoel, Director at To The Point Growth Specialists, and Kevin Hodges, Mining Industry Champion from the IDC. Gentlemen, thank you so much for joining us today, and we're certainly looking forward to a vibrant conversation which won't leave us depressed. But maybe that's where we need to start off, by gauging your views, hopefully, on a scale of 1 to 10, because we understand the global market issues, the slowdown in China, together with the slump in commodity prices. But Kevin, let's start off with you. Your view on the mining industry in Africa for 2016, on a scale of 1 to 10, with 10 being the most optimistic. Where does your number fare?
4.
4.
I would say 4, yeah.
Any particular reasons as to why?
Look, I mean, you know, if you look back a few years to the commodity boom, I mean, Africa attracted a lot of funding. I think it was second highest. A lot of that was aimed, I mean, South Africa attracted a large amount, I think 45%, but a lot of that was sort of expansionary, more brownfield funding. Africa attracted a lot of early stage exploration funding, and that funding is pretty much dried up now. There's just no capacity for early stage exploration funding.
4 from Kevin. Bernard, your number?
I would have liked to say 1, because then there was only scope for improvement. But I think it is as tough as I've seen it in my 30 years. I've never seen circumstances as tough as this. But it's likely to get tougher. I mean, you know, the rand bought some exporters a bit of leeway, but nothing else is yet, you know, bottomed out. So I'm glad I'm not a CEO of a South African mining company.
Not anymore, quite clearly.
Indeed.
Philip, let's get your view.
I would say I'm a little bit with Bernard, maybe 2 or 3, because I agree there's a little bit more pain, but put differently, there's lots of upside once we get to the bottom.
Wickus?
I think if break even is 5, I'll go for a 3.
3 out of 10 there. Andile, let's get your number.
I'll put it at 4, actually. We are facing a number of headwinds, and we have not even seen the bottom. You know, things could still get worse before they get better, but there's real potential. I think we need to accept the fact that it is a cyclical industry. It's a long-term investment horizon, that one we need to look at, but we're actually going through one of our most difficult times that we've ever seen in years.
I'd like to stick with you and get feedback from your colleagues at the desk as well, who can come in at any time of the conversation. But fundamentally, some people do say that we saw this particular end in the commodity price cycle coming. 2016 was eyed to be the turnaround year when it does come to the mining fraternity. But are all fingers still pointing at China, given the fundamentals in that particular economy moving now away from infrastructure to consumption and growth? Clearly, the demand's not going to come from there. Which particular markets should we be looking at?
Well, let me just start off by the role of the mining products. I mean, I think the levels of consumption, you know, might have slowed down, but there is a need and a role for mining, you know, in the economy in general. So we must never lose sight of the fact that even if we're going through a boom time or a downturn in the market, we have not found substitutes, you know, that will be able to say in the place of diamond or in the place of coal, you know, we're going to be able. So let's clarify that. But we're actually going through a difficult time where we've got excess capacity, you know, in the market. And it's going to take a while for that to recalibrate into levels where it matches up with the demand. So that's the first thing. We're likely going to see some more pressures in prices, you know, but also the fact that our cost base, you know, is not competitive globally. That puts us in a disadvantage, you know, during times where we have lower commodity pricing, you know, circumstances that we see at the moment. But it will turn. I think at some point, you know, we're likely to work out some of that excess supply. Hopefully the demand will come through. but there is always a possibility of new markets, you know, coming through, boosting and bolstering the demand, you know, for commodities.
I would just remind everybody that China is slower growth, but still growth.
Yes.
Yeah.
So let's not blame China. Let's blame bad capital allocation by mining companies, overcreation of capacity. We grew capacity faster than what China can absorb, which is quite something, because China is still growing. And there may be exceptions, but if we generalize for a moment, then China is buying more this year than last year in most commodities. So China is growing, but at a slower rate.
Even if having seen the 40% slump in commodity exports from South Africa to China in the first 6 months of last year.
But that makes the point that we are losing the battle against Australia and other countries. So that is a South African perspective. So, you know, we need to deal with that. Why are we losing ground against others? Why did we miss the super cycle? Because remember, we never really participated in that because we were constrained and the export facilities were not adequate and so on. So there's a South African conversation, but in the world of commodities, I think there's still growth in consumption of most, and we just managed to create capacity way beyond what the world needed in the short term.
Yeah, no, I could add, I think that's particularly in your bulk commodities, the iron ore,
Yes.
particularly, to see, which of course was a large, China was a large consumer of. And which, I mean, Kumba was selling iron ore at $150. It's now down to $40. You know, I mean, that's pretty hard to keep your company running under that fall in price.
Exactly. Let's perhaps explore this further. And Philip, I'd also like to get your view as to why South Africa, Wickus as well, is falling behind here. As Bernard already alluded to, we didn't participate in the super cycle. Some point to infrastructure being the deficit when it comes to SA.
Yes, I think, if I may just pick up on Andile's comment, there is merit in reflecting at this point in the cycle that mining will always be a boom-bust business. And so as we encounter the trough of the cycle, the seeds are being sown for the recovery. And I think that's just because mines, as Andile was saying, take a long time to discover and to build. And they're very long lead times before that metal comes to the market. And they're very long lead times, as mines generally are quite long life, before it comes off. But they come off in these big step changes, which we can discuss the specifics of demand today, but there's always a disconnect at a certain point in the cycle between supply and demand, and I think that is something which obviously makes the sector particularly interesting, certainly from my point of view. But in relation to South Africa, I think the issue in relation to the super cycle was indeed infrastructure. Our infrastructure was designed many decades ago for a very different world construct in terms of supply and demand of metal. And suddenly there was an opportunity for us to benefit from a new customer in the market who went from a negligible percentage of consumption of metal to 50% of all metal produced almost anywhere in the world, and minerals. And we just didn't have the pipes, metaphorically speaking, to send that metal to market. And by the time we did, or we do, others responded more quickly.
Yeah, the growth in export revenue from commodities was only prices. There was very little increase in volume over that super cycle period. It was mostly just a price.
Wickus?
One of the things you've got to consider is also the basket of commodities that we have in South Africa. So, you know, if you think about the key commodities during the boom times was copper, coal, iron ore, all the bulk commodities used for infrastructure and power. And South Africa is not a major producer of copper. It's got 2 or 3 key mines around iron ore, you know, and the other sort of base metals is quite limited. But we're very exposed to the precious metals, platinum, gold, those kind of things. So that doesn't necessarily require logistical infrastructure, just lots of power. And that's the kind of shift that we saw. You know, the infrastructure wasn't necessarily geared for the boom that was there. In other words, you know, getting it on the train, getting it out the harbors and getting it off to the Far East. And we just weren't geared for that at the time.
That has always been alluded to as a deterrent of foreign direct investment, especially when it comes to the South African or African mining fraternity. But to take 2 steps back, as you all alluded to, is the fact that we weren't necessarily ready from the get-go. What would have been a more appropriate stance that mining companies should have taken before we reach this particular point of calamity when it comes to the demand side of these commodities we export? Bernard?
You know, I think if we were to boldly go 10 years into the future, we're going to have a government who's going to interfere or intervene even more in our lives. I mean, that's stated policy of the current government. And I think we therefore need to start to hold government accountable for the things that they already own in a monopoly environment, which is the energy supply on the one hand, the railway lines to the ports. So there's not much a mining company can do. I mean, if we were to talk specifically, say, around manganese, where I believe we've got the world's best ore body, but we are almost insignificant. And between us and the market, which love our product, there are a couple of constraining monopolies controlled by parastatals or state-owned enterprises, as we call them today. And so if government is going to continue to be bigger and bigger in our lives, they need to step up and actually take long-term views. They need to not undercapitalize. They need to not miss the cycle, and a government that wants to be, intervening or centralist, they need to then take a 20-year view. That will actually be good for the mining industry. Quite honestly, governments can easier take a 20-year view than a fund manager. I mean, fund managers amplify our investment challenges because they've got a 3-month time horizon, and if you can promise them growth in 3 months, they are behind you until they're not behind you anymore. So I'm not anti-government's involvement, but they must step up and then do it properly. They must take a 20-year view. Otherwise, we're going to miss the next boom cycle.
Can I just come in on this? I think also, to Bernard's point, what we may want to look at going forward to avoid this challenge of constrained infrastructure capacity is to open up the provision of infrastructure, not only to be limited to government participation, to allow the private sector some part in terms of reducing the burden on government in terms of providing the requisite capital, but also to improve on the efficiency and speed. I think part of building a different story for the future, we need to create that openness in the conversation.
Gugu, can I ask if Andile believes realistically that that's happening in the next 10 years? Because, I mean, for the moment, our government has just recently progressed to the next level, the state mining company legislation. We see more not interference in a bad way, but we see more involvement by government, not less. And so the dream of private sector of privatize and give us access, I don't foresee that as realistically achievable in the next 10 years. And if that holds true, then we need to have a different conversation. Then the realistic conversation is government, then do it properly, if you insist on doing it. But it's a very long question.
Yeah. But I think it's worth putting it on the table, Barend, as one of the options that we need to look at, to stimulate growth and actually making ourselves as a mining industry globally competitive. Because some of the forces that are at play are beyond our own control in terms of the speed of bringing the product to the market and making sure that it's efficient and we're globally competitive. We've got to try and have a different compact in terms of how we want to approach these things, as an industry.
I'm glad you mentioned this, and because if it does perhaps then to start with government and the kind of policies and regulatory framework that they put in place, how do they do so to make sure that the regulations will appeal to both or all cycles throughout the commodity cycle and mining environment? So whether it's a boom or whether it's a bust or a decline that we see in that kind of environment, what does this tell us then about timing? And perhaps could we pick up examples from mistakes that might be taking place in countries like Zambia, where again they hiked up some of their prices with regard to copper in recent years, twice in 6 months, which again adds a negative impact to investment. Philip, Kevin, Wickus, feel free to jump in here. What does this tell us about timing? Is there proper timing that we need to implement when it comes to regulations, and how do we make them apply to all times of the cycle?
I think everyone mentioned, sort of the cyclical nature of mining, and the reality is you're never going to get that timing right, just because it takes so long. And I think therefore it's so important when you've heard it for the last 5 years, we want transparency and predictability in policy, but it can't be overemphasized how important that is. You don't have to get the legislation 100% right. I think we'll live with 90%, If you get it there and we say this is it, we all sign up to it, it was transparent, there's a clear understanding why the legislation is written in the manner in which it's written, and then you deal with it. It doesn't, but the moment that you start introducing change, that's when there's second guessing and doubt and breakdown of trust and all these other things that we can use to describe it. So the key challenge for me is making sure that, and that would be great if we can hear it at the Indaba and with the minister when they have their speeches, you know, to kind of give a vision. Where do you want to go? And let's sign up for it. Let's get it penned and leave it like that for a while. Don't fiddle with it on a regular basis, because that gives us a platform to operate from.
What about when government comes back, excuse me for a moment, and says that we've actually been consulting with the private sector before we actually pencil in these changes? Then are the concerns still warranted?
Look, I think the challenge, if we're honest, is there's always a disconnect between the commodity cycle and, let's call it, the social political cycle in the place where that commodity is mined. And you mentioned Zambia. I think we've experienced some of that in South Africa. Of course, in South Africa we have a long history and many specific issues in our country in the mining sector which we have to deal with as an industry. But that intrinsic tension between, let's talk about Zambia, the copper cycle and the desire for the government to protect those who are employed in and who depend on the mining industry in that country is always going to create conflict. So Anglo-American will remember well, you know, the 70s, and in some ways we've seen a version of that cycle playing out again, I think, in these last 5 or so years, where it is very tempting. It is the mandate, so to speak, of the politicians to represent people who are affected negatively by cyclical changes in the industry. Mm-hmm. That's the reality, I think, around the challenge. You know, you hear from our clients and from us, which is create certainty. This is a 20-year game. Mm. We have to acknowledge that within those 20 years, they're very deep cycles through which we have to travel.
Guga, for me, and this comes from the last 2 or 3 years of conversation we've had at the Joburg Indaba, which is really people sitting and discussing issues all together. We need strong political leadership. We need a minister who sounds like he believes in mining and says so. Privately, he can smack us like naughty children, but publicly, we need somebody to promote mining. The government owns, the people of the country owns the mineral deposits of our country, the mineral wealth. Nobody else is going to spend money on it unless there's an expectation of a decent return. There are clear success stories in the world of funding exploration. You started the intro with saying we've got we've got a major portion of the world's riches. We spent a fraction of the development expenditure. That will constantly constrain us. The money for exploration is not going to come from Anglo or any such an organization no more, for various reasons. So government has to incentivize, and we don't have to copy the Canadians, but we don't have to reinvent every wheel with flow-through share schemes, etc. If we make discoveries, then people have got 7 years to use the pot or get off it. Mm-hmm. I mean, to speak mining language. So we either then build a mine or we forfeit the rights back to the people of the country. So it's as simple as that. In 7 years from now, we could be the center of the universe's exploration capital. If government today, and it doesn't cost a lot of money. It's not government money, it's concessions and tax flow-throughs and so on. Sometimes the crisis makes people pay attention to the simple things, and in 6 or 7 years from now, Joburg will look like the exploration camp it was meant to be. More people like me and less bankers. So it's
going back to how it fundamentally started, right?
To start and to follow on with what Bruno was just saying now, the exploration and the long term. I mean, you're looking at a 30-year view of a mine and the life of the mine. And with that policy, so the policy uncertainty, I mean, people who are investing look at the risks, and they want to know that they can either avoid a risk. If they can't avoid it, you know, they can mitigate it. And perhaps if they make a mistake mitigating it, they can remedy it. Mm. And the thing is, sometimes with the policy uncertainty, you're not sure that you make a mistake or you have made an error in whatever. And the remedy is quite disastrous. And you can't remedy it. You know, perhaps your license is taken away. And that's very difficult because they can't assess the risk properly with the policy uncertainty. And so they hold back until they can see a clear view and then be able to say, I can manage that risk. If I do it this way, I can manage it and I can mitigate it.
Piggybacking off of the theme of regulation, I want us to also tie it into the buy-in of stakeholders. Given the recent headlines, we know that South African mines are approximately looking to let go of over 30,000 plus people. We also understand that naturally mining does obviously contribute significantly to employment levels as well in South Africa. With regulations, and piggybacking off of that is a theme for Black economic empowerment as well within the South African sphere of things, and the buy-in when you get in touch with some of your stakeholders, but they hear about the constant job cuts and restructuring from a newspaper perspective. How do we do that? Is there a way of instilling confidence within our stakeholders despite the negativity and the job cuts and the restructuring that needs to take place, but also abiding to the regulations, which at times can be quite difficult? And we know the common theme in mining these days is the argument regarding once empowered, always empowered. Wickus, maybe if you can give us your views there. Andile, you can come in through.
Okay, sure. Yeah, so I mean, given the cyclical nature, you're always going to find it. It's never nice to lay off people. I don't think anyone likes that conversation, but sometimes it's necessary to bring your cost base down. And I think the key for me is that, I mentioned earlier the diversification of this basket of commodities. Not all the commodities always follow exactly the same cycle and exactly the same timing. This is an exceptional case where everything is going in one direction. But if you go back a year or 2 or 3, you saw base metals going a different direction from the precious metals and the bulk commodities. So if you take an area like, say, Rustenburg is known for platinum, but in our north, south, west and east, you'll find either copper or you'll find other base metals or chrome or bulk commodities such as coal. So the point that I'm trying to make is that there might be job losses in a specific company or in a specific area, but that doesn't necessarily mean that it's an overall reduction of employment for the country or the industry when you have a diversified sort of mining economy. And I think that has to be a key focus. Now, obviously, all of that has to be underpinned by proper infrastructure. And I mean, we can't make that point enough around the infrastructure. They say never waste a good crisis. Well, this is perhaps a good crisis for us to open up the potential participation or funding of, large-scale infrastructure. We saw good energy participation by non-parastatals, by private money. And I see no reason why a similar model can't be adopted in many other aspects. Water is the next big crisis. A lot of innovation is required in reducing the demand on water, particularly by big mining companies and other large consumers. So I do think there's a lot of opportunities, but it comes really back to, I think fundamentally it comes back to trust. And if you get the trust right, that's when you start seeing opening up these opportunities and cooperation agreements.
Can I just maybe raise a couple of things? One is it's important to accept that there's no one silver bullet that is going to fix all of the problems. The issue of the infrastructure is just but one of the challenges that is confronting us as a sector. And we must address it. And we also need to accept the fact that we need to put all of our hands on deck. And Wickus is correct when he speaks about trust. But we are hoping that this kind of crisis that we're facing at the moment, it will create sufficient momentum, for us to get around the table and think creatively and out of the box in terms of the kind of solutions that we need to end up with. That will help us to be better positioned for the next cycle when it picks up. So that's the first thing. It's also a fact that we are building a lot of excess capacity, so we are forced to actually cut back so that we'll be able to survive the downturn. And unfortunately, it's going to mean that we have to reduce, the number of people that we have in our own employment. It may also mean that some of our assets that are not operating profitably, at these low commodity prices, we may either have to put them on care and maintenance, until such time that the price starts picking up. On your other issue that you're raising around Black economic empowerment, I think for the national stability, we have to address that. It's both a national and a strategic imperative. We just have to find ways in which we make it sure that it works for everybody. In other words, that whatever we have agreed upon and we have negotiated, it's implemented according to whatever those regulatory obligations are, but we're consistent, In other words, we do not then change the rules, because as long-term investors, what we would like, if you're investing for 20 or 30 years, and say this is the deal that we have agreed with you on, you know, let's make sure that we are consistent in the way in which we implement and execute that. I think if we can try and work around those kinds of parameters, that would in itself start creating a requisite platform, you know, for investors to come in. The last one is the labor situation, labor stability, to be more precise. You know, it's another issue that we obviously have to try and collectively find a solution that works for everybody. So Gugu, my point here is that we're not going to look for one solution and say if we fix regulation or if we fix infrastructure, et cetera, we just need to have a different conversation amongst ourselves as key role players to say, what is it going to take for us to bring our industry back on track for the long term?
Bernard, I thought you wanted to say something.
Yeah, I would love to comment, especially on the issue of employment. Through the boom cycle, the number of people employed in South African mines came down. We're down from 1.2 million not too long ago to 400,000. Again, I think we need to openly start a conversation to say in 10 years from now, our industry is more likely to employ 100 or 200,000 people than 400,000 people, because we are denying the truth. Now that truth should flow through to all conversations. There are such themes underlying, the modernization theme, and I'm not talking about mechanization, I'm talking modernization in totality in all its components. We are going to employ less people, and the country can't impose on us to employ people because the companies is just not going to do that. We're going to have a lot less people. They are going to be in different conditions. They're going to get the types of minimum wages that the unions would finally have no reason to exist no more. But in a moment, in where we are now, the unions are fragmenting. You now go to a industry conversation. There are 3 unions representing one group of people, and then Solidarity, and then WASA. So we are clearly in a very stressful time where things are fragmenting. You would have thought if there was one union representing most of the workers in a 800,000 people industry, you would have one union now. We've got 3. So I think that the employment conversation are not being had by us as South Africans honestly. And there's no trend that indicates a turnaround. Yes, copper may employ 5 people more, but overall there's a trend which is so clear, and we should have that conversation.
So Bernard, I think part of that is also, in fairness, some of our mines and some of the commodities we operate in are unfortunately sunset operations. They are 100-year-old.
Platinum and coal you're talking about.
Obviously not gold.
No, obviously not.
And that is a reality which we will have to face up to at some point in time, just given the nature of ore bodies. They're finite economic resources. But I would
the last coal mine in the UK closed down recently. Exactly. The last coal mine in a country which at some stage the National Union of Mine Workers could decide to run the country.
But the point I think you're making the context of your point is this point about trust that Wickus raised. I think the amount of trust that is required to have conversations that have consequences over 30 years, that embrace the possibility of truly innovative contributions to mining production, which on the one hand may impact the number of people employed, but on the other hand may, as has happened in the UK, extend the viable life of mines by many decades compared to how we currently operate. I think this question around trust really, for me, I hope, as it has been in some of the conversations that you've hosted, really hopefully will be at the center of what we talk about at Indaba this year, because without that trust, none of these big ideas will ever land.
Exactly. I'm hoping we can get into this a whole lot further in the second half of our conversation, but we are going to take a quick ad break. When we return, more insights and updates as to what might be on the agenda at the 2016 Mining Indaba. Stay tuned. Welcome back. We continue our discussion on Africa's mining outlook. Now, still with me at the desk are Andile Sanqu, Vice President of the Chamber of Mines of South Africa, Wickus Botha, Mining and Metal Sector Leader at EY Africa, Philip Lindop, who's the Head of Investment Banking at Barclays Africa, Bernard Swanepoel, Director at To The Point Growth Specialists, and Kevin Hodges, mining industry champion from the IDC. Gentlemen, just before the ad break, we got into the all-important discussion with regard to labour, not only just labour relations, but the future of labour all overall when it comes to the mining fraternity. And I'd like to gauge some of the views from the gentlemen, especially Philip, together with you, Wickus, with regard to what your clients are telling you. Kevin, you can obviously come in here with regard to what we're seeing from your activities as well across the continent. But this conversation around labour and the changing face of labour when it comes to mining, how critical is it? And fundamentally, again, how do we ensure that there also are benefits in the long-term effects when it comes to the additional sectors that help support mining, which might be able to indulge in job creation going forward?
So I think for me there are 3 points. Firstly, labour has historically been the main single cost item in mining, and as we were discussing in the break, that's rapidly become power. So with all the efficiency initiatives and all the productivity initiatives that mining companies and their labour forces have undertaken, that shift has already happened. I think the second point to make is, you know, the typical pressure valve in a time like this in the cycle is the currency. And so whilst many other prices have been more or less correlated than they historically should have been, we certainly have seen weakness in the rand for all sorts of reasons, which has provided relief for South African miners and miners who operate in countries with commodity producer related currency. So I think there has been some give and take on that, and you know, really the question there must be around in total cost terms, how do you survive? But for me to even have that conversation credibly, there has to be trust, and I'd like to refer to the meeting which has been reported widely that Minister Gordhan hosted last Friday with senior members of the business community, not just the mining community, although there were representatives there. That trust, that conversation, hopefully is not too late, but has happened perhaps all too infrequently, and maybe there is, you know, the sense of a crisis that is bringing people to the table, but without that dialogue, it's very difficult to deal with some of these big strategic conversations.
Yeah, I think on the labour front, you know, it's not a mining issue. It's a global issue, and it's across industries. If you look at banking, you know, you can look at retail, you could look at any of the sectors, you know, you would see the same tension. And you know, recently at Davos, I think that the theme was
the fourth industrial
exactly
revolution,
the fourth industrial revolution, and it was a big debate. But so really, the point about it is that it's inevitable that you are going to see the use of labour going through different sort of themes and different kind of focus areas. But one of the things is, you know, a machine does not operate itself. You know, a machine needs support. They need operators. They need people to invent them. They need people to refuel them, and they need a lot of other things that goes with it. So the point is really that I think if you're looking exclusively for a mining job, somebody that's at the coal face, well, you will see that sort of diminish over time, but you will see other kind of jobs supporting mining industry, supporting the broader sector, that you will see. And I think if you speak to our youth today, you know, that's what they're looking for. They're living in a connected world, they're living in a digital world, they're living in an innovative world. That's the kind of jobs they're looking for. So, but the mining sector can produce that, and the mining sector does offer them that. It's going to happen over time, but I do think perhaps sometimes if we are so focused on protecting jobs, perhaps we're seeing the bigger opportunity and the bigger price, and that's really you know, completely, you know, revitalizing the way in which we see mining. And it's not the dirt diggers, it's actually, you know, an essential part of what we are on Earth.
Exactly.
Can I just come in here?
Go ahead.
I just think that maybe if I can make 3 points. We are price takers in the market. So whatever price that our commodities are selling for in the global market, that's the price we're going to sell. The only area that we can compete on, and that is really under our own control, is our costs. Now, taking into account what our own challenges are in South Africa, in terms of being still a developing nation, how can we make sure that we come up with a solution that enables us to reduce our costs on the one hand, and yet be responsive to some of our own developmental challenges? That is the conversation that we need to have. And in my mind, it's quite clear that we will have to take some of those costs, out of the system. And it's either we are forced to do that, or we are able to actually be ahead of the curve. So, for example, if, let's say hypothetically, we were to lose some of the jobs in the core area of mining, what we will obviously have to look at as an opportunity is to say, in the value chain of mining, for example, in the manufacturing of these mining equipment, can we look at ways in which we could localize, the manufacturing of those mining equipment? Mm-hmm. So in other words, we will then create a completely different skills profile in terms of the people that would operate, in that kind of an environment. But then we will be able to build some new industries that are supporting mining that also have the potential to be globally competitive. So I'd really think that we can actually take advantage of this crisis and yet launch ourselves and open up new opportunities. But we have to work collectively in those discussions.
Bernard, you've been very vocal in saying that maybe this is a difficult a project to implement given the challenges that we face as an economy. Power, skills?
Unlike my colleagues, I don't have to live with the challenges of tomorrow. So I can comfortably go 10 years into the future. We have to ask ourselves, will society still support us sending a person underground? So America is waging wars, some would say all over the world. There's not often a soldier underground anymore. It's remote wars. It's joystick wars. Our rock drill operators, RDOs may become RJOs, remote joystick operators. We can today mine from offices in Sandton, somewhere remote in South Africa, without a single human being interacting with the risk environment. It is technically possible. That's before the Internet of Things. It is still more expensive. But if labor cost goes up, if the price of safety or lack of safety goes up, if environmental cost goes up, like it should and like it is, then the crossover point sits much closer than what we are today contemplating. And that's why I like 10 years. 10 years is so far out, none of us will remember what we said. But in 10 years from now, I will be extremely surprised if people go underground for a shift.
Which is certainly what we don't want. Kevin, are we seeing the private sector investing sufficiently into these particular skills? Or does there again need to be a balance with what the regulatory environment suggests? Okay,
before I answer that, I just want to go just back, follow on Bernard, and he made the comment about modernization and mechanization. And the conversation, productivity. There's a conversation between mine owners and labor. When productivity comes up, it's a very, very tough conversation that is had. But the thing is, there was a comparison. I saw some figures, or someone told me a figure that our ounce per man produced per man today is the same as what it is in the 1930s. And you say to me, but that cannot be. But it's not a factor of a miner's productivity. It's the fact that he takes, on an 8-hour shift, 4 hours of his time is taken to get to the face of the mine. Because they're deeper, they're older mines.
So we're almost using the same strategies we used back in the 1930s.
Correct. You're also mining ore bodies that haven't got this high grade as well. A lot of the high grades have gone. So yes, your productivity is down. Now, that situation where you've got a machine at the face, it's working for 8 hours. And people talk about beneficiation, and they always seem to think of downstream beneficiation. There is all of this mining equipment upstream, and all of that supports a mine. So it doesn't, in my belief, it doesn't matter if you can't beneficiate downstream. You build a mine. There are hundreds of companies that support a mine. And that's what we need to be concentrating. We need to be innovative in terms and develop and sense it and have incentives to build that upstream mining industry that supports all of these machines that we can get underground and become a much more productive mining
Kevin,
industry.
I'd love to jump in there because there's a great precedent. It's called the auto industry in South Africa. We've done this before. We know exactly how it works. All of that engineering and manufacturing capacity and skill from some of the best operators in the world sits right here in South Africa, and it's a very adjacent set of skills, I think, to what we're talking about here, which I think creates an enormous opportunity.
But the government's got a reindustrialization policy, and then we add black to it, and there's nothing wrong with that. So we'll create black industrialists, and we need to do that. But I think, again, government now has put their hands on so many levers that we need to now look our government in the eye and say, please pull some of those levers. I mean, if the IDC were to go back to its original intent, long-term capital for long-term projects, then the mining industry will look differently. Then we will start to build mines like we had to and used to, you know. And sometimes it was funded via Eskom's balance sheet as a cost-plus mine. And I mean, the old ISCOR and Sasol all came from government funding. Today, the free market guys will object to that and call it, I don't know what we'll call it, but by some ugly names. And yet it has served this country well. So government must now operate the levers they control. And institutions that can fund over a 20 or 30 year period must do that, and it can't be, and it won't be the banks, it won't be the American investor, it won't be the fund manager in London. They can't apply any model so far out, discount the risk.
But let's ask them. We've got a representative from a financial services institution and an industrial development corporation here. What does this tell us about the future of financing models? Because we see companies trying to raise capital on the markets. Unfortunately, some of their rights issues are being undersubscribed. We know that foreigners aren't necessarily bringing their capital through here as well. Where could we see the capital that's needed to fuel these projects and solutions that are being tabled here today? Where could that come from?
Well, there are two kinds of capital, right? There's risk capital, and then there's further down the capital structure, there's sort of more secured capital. And I think the risk capital we talked about in the first half is all about trust and belief and certainty over the long term. So in relation to the more secured capital, I'd perhaps point to two things. The renewable refit program here in South Africa has been an extraordinary success. It has entirely been funded by the private sector, by the banks, and by the risk capital of local and global entrepreneurs. And it has been done taking a view, or if you like, renting the Eskom balance sheet in some sense. So those are 10, 15, 20-year projects. I think what's interesting, which comes to the second point, is that all capital, like mineral resources, is finite and scarce. And at this point, post the financial crisis, with all the regulatory intervention that has come to protect capital, that and taxpayers who support the capital industry, it really is very important that we're allocating capital efficiently. And I think there is a role for banks to play. I think there's a role for capital markets to play. But there is also a gap, I think, for government to take a long-term strategic view around certain commodities and certain assets, hopefully the best that we have, and to create these cornerstones of an economy, which I think today Sasol and certain parts of the steel and other industries absolutely represent.
Kevin, let's quickly get your views, just to find out if you are holding tightly to those purse strings.
No, the IDC does, operates in both capital markets, the loans and in the early stage equity. Especially, over the last period, we've tended to move a little bit more to the debt funding, and our early stage project development has, just through strategic views, the strategic views of our shareholders at the time has sort of lagged behind. Recently, we've had a review of the organization, and we're busy trying to develop and get that early stage development funding going. But it's always been there, and we still have that role. So it's a sort of a private equity approach, except we don't have a private equity liquidity event or an exit mechanism. I mean, our role is to develop a project to the point where it's mature, the jobs have been created, and our role is no longer really needed. So it's quite a nice model. It's not used very often because you've normally got that early stage private equity that needs an exit point. We don't need that exit point. We need to get it through to maturity and see something develop. So the latest initiative, which has been it's been in the press, is a modern steel plant, because all our current steel plants are not efficient. They just can't do it. So that's probably the first one we've done for a while, and we've got a team now working very hard at seeing if we can put up an efficient steel plant.
Bernard's going to nudge you very closely, I think, with the 10-year view, the long-term outlook. And the fact that you've mentioned that, another point comes to mind with regard to sustainability, which I understand, again, might be tabled at the Mining Indaba going forward this year. Andile, from your perspective, and you can also come in through here, Wickus, this particular theme, not only modernization, but mining in a sustainable manner, which does not harm the environment, as we've seen consistent reports about the acid mine drainage and such. Are there potential solutions that can be implemented here, and maybe lessons that we can learn from our international peers with regard to this?
Look, I mean, there is a regulatory framework in South Africa that deals with these issues. I mean, for example, if you look at the mining charter itself, it's got all the elements, and there are issues such as health and safety elements where mining companies have got obligations in terms of what it is that they're supposed to do, you know, in terms of fulfilling their obligations. Similarly as well when it comes to areas of the environment. And I think the focus that we're having even during this time of downturn, my colleagues will agree with me that there's so much money that is being put into areas such as community development, for example, even BE transactions. And because that really talks to long-term sustainability. You know, when we're talking about sustainability, we're not only talking about our own business, but in the context of our own environment. So our approach is holistic. It's unfortunate now that our focus is about survival. You know, the industry is in crisis, so the natural focus is to say, what are some of those things that we can do today to make sure that we stay in business? But at the same time, elevating our eyes towards the future. There's some of those things that we can do together to make sure that we sustain that future. There has been a project that we worked upon last year as an industry, government and labor through the mining Pakisa, which really talks to the future of the mining industry and the long-term sustainability. Still work in progress, but I mean, all of that it creates very strong foundation for the future. However, the focus that we are all, and I would imagine even at the mining industry, is going to be about how do we make sure that we survive the downturn.
Gentlemen, we do have about 5 minutes left for the conversation, and maybe this is the opportune time to get your closing remarks on the key themes that definitely need to be explored at the Mining Indaba and potential solutions that really need to be looked at in the short term, given the current cycle that we're in at the moment regarding commodity prices. Andile, let's start off with you. Just your closing comments as to what you hope will come out from the Mining Indaba, other than potential stepping aside to drown our sorrows at the vineyards in the Cape.
Look, I think the most important thing, Gugu, to mention is that this is a cyclical industry. So it's going to turn, you know, so we should not really think that it's the end of the world.
So there are solutions.
So there are solutions, and we should really be looking at the potential that exists. But I think that the whole issue of trust, for example, as Philip has mentioned, you know, will take us a long way. But it's trust in action. In other words, what are some of those things that we would need to do collectively with labor, government, and ourselves, you know, to make sure that we have a robust and a sustainable industry. And we need to have very honest and frank conversations. Some of them are not going to be comfortable, but are necessary to make sure that we restore our industry to its former glory.
Wickus?
You know, as we are here today, you and I, we're part of 1.3 billion middle and upper income people around the world. By 2030, that's going to be more than double. So the point is that, you know, the extra 1.3 billion people are going to need natural resources. So that means I don't think mining is dead. In fact, I think all the mining products, there's a big market for it. But the challenge for Africa, and perhaps more closely South Africa, is to make sure that we position ourselves, you know, because it's going to be quite competitive with everyone. Everyone's going to chase the resources to, you know, for the construction and development. So we have to position ourselves well, you know, to participate in that.
Philip?
I think having only had one joke about bankers so far, I should maybe the first comment is, you know, for mining companies right now, it's all about survival, because if our companies don't survive, then, you know, it'll be a tragedy to lose the industry, which has huge ramifications. So that's always easy to give advice rather than to implement it, as I'm sure Bernard would know. But I think the second point is exactly that. We, you know, living and developing economies is very metal intensive. That's one of the most exciting things. The mining industry put South Africa on the world map. It is a global industry. It binds us to the global economy, and you know, and hopefully the solutions and the conversations we have will keep that in mind.
Our gold bullion here?
Gugu, I still believe if we look back from 2026, we're going to say there were such clear themes and trends in 2016, we should have acted on them. Government's role is going to get bigger, not smaller. In practice, that is the Junior Ndaba will talk about how can government then facilitate exploration as a practical implication. So government's going to get bigger, not smaller, over the next 10 years. The environmental issues are going to get bigger, not smaller. Open pit miners, people who dig holes and leave them, the society is not going to be happy with that, and less so than today, especially around water. If you affect a water flow, you have an issue. And we should not only account for it, but start to think about it. And then modernization, which is not mechanization, which is more complete. In 10 years from now, we're going to look back and say it was so obvious. So those for me are the three big things. And of course it builds on the conversations of previous Joburg and Davos and so on. So I'm just reflecting, but that's what we will continue to discuss.
Kevin, your closing remarks?
We need investment. Okay, look, if we look back what's happened with the boom, mining companies get a bit lazy, costs rise, you've got a nice margin, the boom comes off, you've got to get your costs down, you've got to get cost cutting, everyone's concentrating on doing that so they can survive. But we've got to start, as South Africa, the conversation we have is to attract investment into our mining industry for the next cycle. We've got to have certainty and policy. We've got to have clear policy. We've got to have everyone talking from the same hymn sheet. To saying, to exploration. We have no exploration in the country. That's the sort of things. We've got to get our junior sector sorted out. We've got to get our regulatory environment it's clear and who's got mineral rights, who hasn't got mineral rights. The guys can come in. There's some consolidation needed. There's a lot of fragmented mineral rights. We need to fragment that. Consolidation is much better than fragmentation.
Exactly.
That's what we want to do to go forward.
Tough conversation that's set to be had next week, but I look forward to seeing all of you there and hearing some of the solutions that you do bring to the table. But that's where we leave it for this discussion here on the expectations ahead of the mining endeavour. Tough conversations once more that need to take place, innovative solutions, honest and clear, transparent regulation, together with a view and a guideline for modernisation and where South Africa fits in with the global theme. But a big thank you to all my guests once more for joining us. Andile Sanqu, Vice President of the Chamber of Mines of South Africa, Wickus Botha, Mining and Metal Sector Leader at EY Africa, Philip Lindop, who's the Head of Investment Banking at Barclays Africa, Bernard Swanepoel, Director, To The Point Growth Specialists, and Kevin Hodges, Mining Industry Champion from the IDC. Until next time, from myself, Gugulethu Cele, and the team, it's goodbye for now.